Welcome to lesson number 6 of the Ultimate Credit Spreads Trading System course. This walks you through how to become a self-sufficient and reliable credit spreads trader using strategies that have taken me years to develop and like blowing up multiple accounts to figure out these secrets. Anyways, if you want this guide and handbook for free, go down below in the description and you can get it for free right there. Anyways, in this lesson, we're getting into the elastic bounce strategy. So let's dive into it right now. The elastic bounce strategy is once again a mean reverting strategy. Unlike the first three, the next three is a mean reverting, which means that we're kind of betting against the trend. So we talked about a dip buy strategy in the last lesson. This one is very similar, except there is a key difference here. So let's talk about it on the chart. So again, when we're looking at this chart, we're using the impeccable stock band or indicator to determine these levels. Again, if you want access to this indicator for free, you can join the 10% Credit Spreads membership. Again, if you use the backdoor link, which is available on this PDF only, then again you can get a free hat, shirt, and 50% off, so that's awesome. Anyways, you can also replicate this line using a Bollinger Band, setting the moving average to 200 and the standard deviation to 4. Anyways, as we discussed, the dip buy is when you break below this bottom yellow line and break back above it. That shows momentum is forming back up to the upside. It's overextended and it's starting to move higher. Now, this one is a little different, but very similar, where we're not waiting for the stock to cross back above. We're taking advantage of the idea that the stock is overextended once it cracks this yellow line. Why? Because that's 4 standard deviations. If it breaks out of the 4 standard deviations, then it's pretty overextended and most likely to snap back or at least not drop much further. And as we're trading credit spreads, we don't necessarily need to go any one direction. We need to stay above our level that we pick. So as soon as the stock breaks below this bottom yellow line, that is the entry criteria to enter this trade. Now again, there are some extra criteria we like to look for, but we'll be getting into those in the rules section, which I believe comes in lesson number 10 or 11, something like that. Anyways, let's dive into how we set up this credit spread trade. So if we look at this, we're waiting for the stock to cross below the bottom yellow line that we just discussed. Then how do we set up this trade? Well, just like the prior one, we're going to set it up at 96.5. So this means that we're going to look at the stock's close price and we're going to multiply it by 0.965. So let's look at it. Let's say we're right here. The stock crossed below this level. It's now below the yellow line. We know it hits the criteria. So we're going to take this close price being 36431. So we're going to do that. 36431. We're going to multiply that by 0.965. Then that's going to give us 351.55. Again, we round to the nearest whole number, 352. That means that the strike price that we're selling for our put credit spread is going to be 352. So we're going to go down here, 352. As long as we stay above this level right here, then our trade is going to make money. All right, how long are we going to stay in this trade? 14 days, 2 weeks, but then we also round to the next Friday, so that's typically around 16 days. So that means as long as the stock stays above our level over the next 16 days, then we're going to make money. And so that's how we structure this trade. You're going to plug in all these details with 352 as the strike that you're selling. You're going to buy the 351 right below it as protection. You're going to go out to that expiration date as determined here, and your broker plug in these details. If you can collect the minimum credit, which is the credit you need to collect in order to be profitable long term at a minimum. If you can collect more, that's awesome. But again, that is how you put on this balance strategy. Slightly different than the dip buy one, where we wait for it to go below and then back above to show that momentum is forming back up. Instead, we're just trading it down. So again, if you like to be more safe with these mean reverting strategies, you can just use the dip buying one where it curves back up. Or if you want to be a bit more proactive, you can start entering the trades when they break below the yellow line. Hence, the other strategy had an 84% win rate, and this one has an 82% win rate, so it is a bit lower because we're jumping in early, but we can still generate a 6% annualized return. Yes, that is less than the market average, but once again, we have to factor in how many times does this happen. Well, alone, over the last roughly 10 years, it's only happened 1, 2, 3, 4, 5, 6, 7, 8, maybe 9, okay, 10 times max over the last 10 years, and it generates a 6% return on average every single year. that is a great strategy and something we can use, especially to take advantage of when we are trading credit spreads. But like I mentioned in the last lesson, also stocks, to know that, hey, this may be near the bottom. This will be a great time to buy, get in at a great level without having to guess and worry if the stock's just going to crumble and go against you once you enter. So anyways, that is the elastic bounce strategy. Again, guys, this is an amazing strategy. Please take advantage of it. If you haven't grabbed your guide yet, click down below. If you want to learn more about the other strategies and rules here that will help you become a profitable credit spreads trader, click that subscribe button and hit the bell notification, because the next lesson is coming out tomorrow, and trust me, you do not want to miss out. All right, guys, see you in the next lesson.